Hi all, welcome back to our YouTube channel. Topic that we will have a look at today is from FRM level 1, paper 3, that is financial markets and product. And topic is foreign exchange in markets. It's like a blend of foreign exchange markets and some part from option markets, and some part from hedging using forwards. So like it will test your understanding on all these three areas. So let's see. Yeah, before we go ahead, please do subscribe to our channel. It takes a lot of efforts to come up with videos like this. So let's have a look at the question. So there is a portfolio manager at some company ABC, and the company's outstanding foreign exposure. He is examining, basically a portfolio manager is examining company's outstanding foreign exchange exposure as on June 20 June 1st, 2023. Let me just highlight this one. So it's examining on this date. The manager decides to hedge net receivables or of euro 5 million. So due on December 1st. So we are standing, ABC company is standing as on June 1, 2023. They are expecting a payment of 5 million euros on December 1, 2023. So now he wants to hedge this exposure. So see what happens that basically you are going to receive euro and you want to convert this in dollar. So this portfolio manager is afraid that if value of, say for example, this, think of this as a asset that you are going to receive 6 months down the line. If the value of this asset go down, then you end up making losses. So he wants to hedge that loss. So he wants to hedge this receivable of euro 5 million. That's the problem statement for a portfolio manager. So on June 1, euro spot rate is dollar 1.07 per euro, and the 6 month euro forward rate is, so this is a forward rate at which we can hedge over this 5 million euros receivable, and this is a spot rate. The manager investigates whether it is better to lock in exchange rate by taking a position in the forward contract and lock the selling price in 6 months, or to sell 6 month 5 million euros call option. So see, there are various ways this portfolio manager can hedge this position. So he's trying to evaluate what is a better option. So he has two options. Like one is going for forward. So you can just lock this price. You just think of this as locking price. You will sell at this price, these 5 million euros. So that's number one. And the number two is sell a call option. So basically, this one is bit tricky. So when you are you want to hedge using a option, and you are afraid that value of your asset will go down. So you are bearish on the asset value. So you have got two options. One is you can go for a buying a put option, or you can short call option. So these are two options. So in this way, the alternative that we have been given is a, a portfolio manager wants to sell a call option with a strike price of 1.07. So if you notice, a very important point to notice, option is at the money. So the current spot price is 1.07, and the option that he's trying to sell is also it at the same price. Okay. So he would eventually earn a bit higher premium. That's just for your information. No need to I mean, there is no relevance with this question, but yeah, I mean, it's good to keep good observation when you are trying to understand the question. So it's at the money. Portfolio manager can earn good good premium on this selling by selling this option, but at the same time, when you sell option, you give a right to buy to your counterparty. So they may come reach out to you and they want to buy at this price. But anyways, if they want to buy at this price, anyways, you have receivables. So that's how the the situation is. So now we have been given few statements and we have to evaluate how which of this is correct. So before we do that, let's evaluate or try to explore what happens if portfolio managers goes for a forward option, and what happens when portfolio manager goes for a option way. So let's just summarize the information. So company ABC is expecting euro 5 million on December 1, 2023. That is 6 months down the line, considering we are today at June 1st, 2023, and wants to convert this euro 5 million into dollar. Hence, higher the value of euro, better it is for investor. Or other way to say this is, uh, investor is afraid that this euro value should not go down. So this is something which we already saw. There would be some counterparty who would be paying euro 5 million to this ABC company. So now the option one, company ABC is hedging using FX forward, and option two, another option they have is use of options, wherein they can sell a call option, earn some premium. And this is a information that we have been given as on June 1, 2023. Spot rate is €1 equal to $1.07, and forward is €1 is equal to $1.1. So, and another on the call side, the strike of call option is €1 equal to 1.07 is a strike price. So now he can sell, I mean, basically he wants to sell these euros, 5 million euros I mean, he can sell at this price, or he can short, basically he can short call option, wherein if this goes down, option will become, he would, I mean, he has his money with him, and he can just he has already short in call option, so he has earned some premium. And in fact, the if the value of the this euro goes up, he has his euro 5 millions to deliver it to counterparty just to cover upside. So when your counterparty exercises the call option, basically you already have euro 5 million with you, which you can deliver to your counterparty. And if it's go down, I mean, you already have premium with you, and did you have written it at the money, you will earn definitely earn a good premium on that, which will cover your losses when it goes down. So before we go ahead, you need to understand few terms which I mentioned. I used but you need to understand that. So when we say depreciation, it's the value of currency going down. So example that we have been given over here is when price of €1 was initially $1.07. From that, it went down to €1 equal to $1.03. So basically, earlier your €1 can get you $1.07. Now it can get you less amount of dollars. So your euro has depreciated. We can conclude in that way. In fact, this is a problem statement for this portfolio manager. He's afraid that when I convert my 5 million euros, if the value of euro has depreciated, I may end up having losses. So that's the main problem statement portfolio manager has. And appreciation is kind of value of currency going up. So say for example, if your currency initially was at €1 equal to $1.07. Now it has gone up to €1 equal to $1.1. So now your €1 can get you more dollars. So your euro has become stronger. It has appreciated. So yeah, this was the information that was required to evaluate question. Now let's explore what we have been given. Just give me a moment. So this is information that we need to understand. So firstly, a portfolio manager can short these 5 million euros at 1.1 million, 1.1 per 1 euro equal to $1.1. So he can get $1.1 for each euro in his entire corpus of euro 5 million. So we have to evaluate what would be the value of forward for different bands of the euro prices. So initially, just imagine that on June 1 it was 1.07. It can go down till zero point 0.1, or it can go up to 1.8. So let's evaluate what would be my 5 million value if my prices of euro are in this column A, you see. So when I say I have short forward, so basically at certain price, that is strike price, so I would get that. So I will sell my euro at 1.1, so I will get $1.1. So it is receivable for me, or euro that I have sold. So I would get $1.1. So I will receive this $1.1. So I'm writing this in a plus. And euro, if I were to write in a euro, of course, you would be paying, so you can say negative, but I want to evaluate what I would get in dollar terms. So it's $1.1 that I would get. And say spot price at that time at maturity December 1, 2023, hypothetically, it goes down to 1 euro equal to $0.1. It has depreciated drastically. So what is the profit from your forward? Because you are selling at a higher rate, and market has gone down. So if you have hedge your position using forward, you will have a good amount of gain. So say this is for 1 euro, and I want to calculate it for 5 million euros. So just let's imagine that this is million number. So let me just increase decimals. So eventually you will have 5 million gain for this one. Let's see what's the gain for rest of the uh, prices range. So way to interpret is, say for example, if you notice that at 1.1, when your market price and your strike price at the same range, you don't have any gain or loss, because if you if you if you would not have hedged at that time also, so you would not have any gain or loss. So this is all. So basically, if you notice, this is the area which portfolio manager was afraid, and you can have profits if you go for hedging at 1.1 dollars for per euro. And likewise, if say go up, the price goes up. Say market went to $1.8, and you have, because you entered into a forward contract, you have to sell at a lower price. You ended up having 3.5 million loss, considerable loss. But ultimately, you are mainly bothered about the price of this receivable go down. So yeah, you have loss, but mainly you are concerned. Portfolio manager is concerned about this area where he wants to hedge. So and let's evaluate the another option where you have written a call at strike price of 1.07. So the payoff, short payoff, so it's negative, and what you will pay to a long party, it's max of spot minus strike. So spot price is your this market price. Column A has a market price, various band of market prices, and strike price for call option is 1.07. So this would because see if they can buy euro at a cheaper price in the market, why one would exercise call at 1.07 and buy it from you? So no one will exercise at this price point when till all the way till 1.1. So you can enjoy the premium if you're if it if your euro depreciates, because your counterparty will not come to you to exercise call, so you can have your premium earned, and it would be a considerable premium because you wrote it at the money. So these would be the price. This, so till 1.1, it's kind of 1.1. You have uh, so it's 1.07. Strike is 1.07. Till that, you don't have any gain or loss. So option will expire worthless. Being a short option party, you will earn a premium. So for call buyer, because we are not given a premium amount, else we would have added in this equation, and we would have known that what would be the premium that I would enjoy. And on the other side, if the price goes up, your counterparty comes to you, hey, buy I want to buy at a lower price from you, that is 1.07 as compared to market price. So you will have end up having some losses. But that's the notional loss, because you already have 5 million euros in your custody. So, but yeah, from evaluation point of view, which one is a better option? We need to have this working. Now let's have a look at what options we are given. So first option says ABC would be better off by selling option contracts regardless of how large the changes in effect rate is and in which direction euro moves related to USD. So it says that option is better regardless of the direction. So it is not a case, right? Because if it depreciates a lot, then over here you will have just premium, but from forward you will gain massively. So it is not that irrespective of the direction, how large it is or changes, because see, premium would cover your losses to some extent, but forward is kind of, it has one-to-one relationship with the drop in the price. So the whichever direction is wrong and how large, it's not really because if it's go down till this range, your premium may not be sufficient to cover your losses. So option A is not correct. We can get this from these two columns. And let's evaluate the option two. So ABC would be better off by entering into a forward contract. So it is saying if euro appreciate against USD by an amount significantly larger than 0.03 per euro, and call option is premium is more than 0.03. So it is saying that the forward would be better if your USD amount if USD amount is significantly larger than this. So if you notice, it's not really case. If my euro is much larger than, so let's see, if amount significantly larger than 0.03 per euro and call premium is $3. So let's try to evaluate this option over here. When we say my call is point, it has premium of 0.03. So let's just copy this formula and let's try adding having a premium of 0.03. So let's have 0.03 in this. So that's the premium that we suppose we are earning. So says appreciates against dollar by amount larger than 0.03. So if my euro is going from 1.07 to 1.1, it's more than that, then forward is more appealing. In fact, if you notice that over here, like if it goes so these are the two columns that you have to compare. This is one, and this is I mean the column D and column B. So if I consider, say, just imagine that 1.8. So 3 point over here, 1 point at 1.8, you have 3.5 million loss, and And for option with premium 0.03, you just have a loss of 0.7 million. So we cannot conclude that forward is better if my gains are if amount moves more than 1.1 million. So you can think of 1.8 or even any number. So after 1.2, any all the losses are higher than option in the short forward contract. So you cannot conclude that forward is better if your moves are 0.03 more than current spot price, because if the uh if your spot in at the time of maturity, if your spot goes all the way till in this range, you will have a massive losses from forward, because you would have earned very higher if you would not have hedged using the forward. So we cannot conclude that forward is better if these moves are this and we have a option of premium of this. So B is also not correct. ABC would be better off by entering into a forward contract if euro appreciate against dollar by less than 0.03 per euro. So now we have been asked to we have been asked to consider this range. So all the way to this band. So if the move is less than 0.03, your forward is better. That's what we have been asked to evaluate. But now you have to consider these two prices. Now you have been not given any premium information. So this is the information that you have to consider in your working. So this is something, let me highlight in some better color. Let's just focus. I mean, colors are not giving a good visibility because of background. So yeah. Uh yeah. So in this range also, there is we cannot say that your forward is better, because if you notice, uh just give me a moment. It says ABC would be better off by entering into forward if your euro appreciate against dollar by less than 0.03 per euro. Okay, so way to evaluate option C is that, see, apparently it looks that forward is better for option C, but in this range we have not factored our premium, because to evaluate option C we would need a premium information, which because it is at the money. So in this range, your option premium will impact a lot, rather than this range wherein option premium would not be able to offset your losses from this massive movement. But in this range, 1.07 to 1.1, definitely if you, I mean, you are given premium, then only you can comment. But in this case, because you're not given a premium information, you cannot evaluate option C. So even option C is also not correct, because you need a premium information to compare a forward and option. And option D, ABC would be better off by entering into forward contract if euro depreciates against dollar by amount significantly larger than $0.03. So it says depreciate. So if your euro depreciate, if it's go in this range, say just imagine hypothetically till it goes till 0.1, then you can have gains like super high gains like $5 million. So that's what it's saying. As against option, which will not give you, it would be like, as I said, that losses from options will not be able to suffice from your premium if it goes till this range. So in that case, your short forwards are, uh, I mean, it's better. A short forward position is better. So correct option for this is D. Just give me a moment. Let's go back to slide from Excel. So the correct option for this question nice and tricky question. You need to be very careful if questions like this are asked in the exam. You need to be very vigilant. Try working for like you cannot have Excel thing in your exam, but try to evaluate at least for 2, 3 row items for this. It will hardly take a minute, but it will uh, cite you to the correct option. It will give you some hint about the correct option. So yeah, hope you like the video. If yes, please do share with your friends who are preparing for FRM level 1 exam, and share with your friends who are FRM aspirants and planning to have FRM as their career. And yeah, we stimulate your thought process. You might have seen in your this video. We try to make you think, which definitely helps you a lot in the exams. Please do subscribe to our channel. It takes a lot of efforts from our side. So please do subscribe, like, comment, share with your colleagues. Stay connected. Thank you.